We'll start the webinar in 3, 2, 1.
Good morning and welcome to this webinar on financing the net zero transition in Africa. My name is Karen Taylor and I am the CEO of Invest Africa. For those of you not familiar with us, we are a leading trade and investment platform for Africa, representing over 400 investors and businesses across the continent since 1956. I'm delighted to be asked by the UN-convened Net Zero Asset Owners Alliance to facilitate this discussion today. This webinar forms part of a wider body of work to boost investment into the green transition in emerging markets. It's an issue that we know will all be high on the agenda at COP27 next month, and I'm pleased that we have such a strong lineup of speakers who are all working to close Africa's climate financing gap. It's not my place to speak for too long this morning, but I thought a couple of housekeeping points would be helpful before we kick off. Please note the session is being recorded and we will circulate the recording to all registered guests after the session. There will also be time for a Q&A at the end of the panel session, so please do post your questions in the chat. And now, without further ado, it gives me great pleasure to hand over to Mark Fitzpatrick, Group Chief Executive of Prudential PLC. Prudential have been one of the key conveners of the Net Zero Owners Alliance and a strong driver of the conversation about securing a just and inclusive transition in emerging markets. Their white paper, published just yesterday, outlines their approach as an asset owner for the long term. I'm sure Mark will tell you much more about this in his remarks, and so I hand over to you, Mark. Thank you very much for joining us this morning.
Karen, many thanks to you and to your team for the work in bringing together this very important webinar. Good morning, everyone. My name is Mark Fitzpatrick, and I'm the Group CEO of Prudential PLC, and it's a real pleasure to be with you here today and for Prudential to be able to support the work of the Emerging Market Transition Investment Project. Thank you for joining us for what I hope will be a thought-provoking and a very useful discussion. The objective of the EMTI project is to accelerate transition investment in emerging markets by identifying and trying to resolve barriers to transition investment. At Prudential, we were proud to join the Net Zero Asset Owners Alliance in 2021 and have a long-standing relationship with both the World Economic Forum and the US ASEAN Business Council. It is great this time to see these organizations focusing on Africa, and the number of participants on this webinar show the need and the ambition as well. Now, we have all seen, even just this year, the damage that has been done across the African continent by climate change. Each country on the continent is faced with some element of this and will be striving to chart their own low-carbon pathway while protecting jobs, energy, security, and economic stability. The financial services community is a key partner on this journey, although the challenges around moving the money where it is needed in Africa are very well known. A recent report brought out by the Climate Policy Initiative, sponsored by FSD Africa, calls for 8 times higher amounts of climate finance than amounts currently invested in order for African countries to meet their NDCs. Now, we are on our own journey in this regard, as are policymakers across the African continent. As a long-term investor in markets across Asia and more recently across our 8 African markets, we can see firsthand the scale of this opportunity, but also many of the tangible barriers in place regionally and domestically. Now, I see several examples across Prudential's Africa footprint of regulators and governments moving ahead in the space, taking best practice from centres such as Singapore and London and adapting them to their local needs. And according to new research released last week by OMFIF and the South African bank ABSA, 17 countries on the continent now have some sustainability-focused policies out of 26 surveys, up from 12 last year. So there is a chance for Africa to leap ahead, taking good practice from other markets and innovating as the continent always does so well. Now, you may hear in my own accent that I'm a proud South African, and I spent my early years living and growing up in Zambia, and I'm thrilled to see the creativity in Africa. And I fully anticipate that pockets of real innovation will emerge from Africa, whether this is in new green investment vehicles or new customer-centric products. And partnerships in getting these into the right investors' hands and scaling them then will be key. The challenge for much of this is one of both speed and of scale. There is a great deal of engagement and outreach to be done, while bringing in ambitious regulations and targets. And for African economies, where sectors such as agricultural are such a vital contributor to GDP and jobs, the transition to low carbon pathways must seem an enormous task. Ministries will be cautious about bringing the whole economy with them. There is no point in having foreign firms meeting ambitious new targets if domestic players struggle to keep up and play their own vital role. Now, it may seem very odd as a CEO of a financial company asking for more regulation, but in this instance, where clear legal and regulatory frameworks really can make a difference for all stakeholders, from customers to investors, and from established investee companies to startups. Looking at this holistically may also go some way to breaking down the tangible barriers in investing, both foreign and domestic. And I am hopeful discussions such as today's can go some way to bridging perspectives on net zero between developed and emerging markets, and to help identify practical solutions that can advance better climate outcomes without sacrificing other sustainable development goals in developing countries. As we all know, emerging markets are key to global decarbonisation efforts. Sustainable economic development and a just transition depends on the capacity of developing countries to simultaneously grow and green their economies, and for that, they will need investment. And Prudential wants to support countries on this transition and have, just yesterday, as Karen mentioned, published a paper drawing attention to the need for this process to be just and inclusive. So if you're interested, this paper can be found on our website and has case studies and content from both Asia and Africa. Both this paper and the EMTI project address the need for local pathways to net zero. Africa has its unique opportunities and challenges, which cannot be captured, in my opinion, in one global framework, which is all too often applied by investors and the larger community. And I was struck in reading the EMTI's project's existing 12 recommendations, just how sensible they are, whether it's the need for taxonomies to address transition finance, to designating differentiated capital treatment to manage financial climate-related risks and guide responsible transition lending and investment to support emerging market real economies, and from asking MDBs to deploy de-risking tools to crowd in private sector capital at scale to manage currency, political and operational risks, and to incorporating sustainable financial principles into a mainstream financial regulations and markets. And I really hope that in this discussion today, you can dive even deeper into how some of these solutions could be adapted in Africa. And we really need the African voice in the debate on the energy transition and the path to net zero. As members of the Net Zero Asset Owners Alliance, we are very pleased that 3 African asset owners have already joined the Alliance, and we would welcome enhanced participation from within this great continent. We are hopeful that today's events will inform those in developed markets about the unique challenges facing African markets and will encourage more stakeholders in emerging economies to get involved in net zero initiatives. And the timing of this meeting today could not be better. With this year's African COP26 just around the corner and its focus on emerging markets on how to finance a just and inclusive transition. So it is now my privilege to introduce our keynote address today. Samaila Zubairu, CEO and President of the Africa Finance Corporation. Established in 2007, the AFC now has 37 member countries and has invested over $10 billion across 36 countries in Africa. And as a leading African development finance institution, the AFC has taken a leading role in developing what a just transition looks like in Africa and how to finance it with their recent white paper called Roadmap to Africa's COP, a pragmatic path to net zero. Thank you very much. And with that now, I hand over to Samaila.
Thank you so much, Mark. Thanks for your very kind words. And thanks for your remarks. Very spot on.
Samaila, we can't see you. I don't know if you've got a camera.
Yes, I tried to put it on, but they said I couldn't do it.
Okay.
Okay, yes.
Now we can see you.
Yes. Thank you very much. So, distinguished guests, good morning. As delighted as I am to be speaking today with you all on this critical topic of financing net zero, I'm also wary in the face of our warming climate of contributing to more hot air. The transition to net zero requires not talk, but action, and crucially, money. And in an African context, it's not aid that's required here, but investment in holistic, sustainable solutions. I must take a pause here to encourage us all that for us to achieve net zero, we need to be pragmatic. We need to be realistic. And if in forums like this, we cannot speak truth to ourselves, then we're not going to achieve net zero. So let's all roll our sleeves this morning and really work between us how to finance the net zero. We'll start with some key numbers that everyone should keep top of mind. Firstly, as Africans, we're the world's lowest energy consumers. Specifically, the average person in Africa uses 180 kilowatts per hour of electricity. That is less than 3% of the 6,500 kilowatt per hours consumed by the average European, and just 1.3% of the 13,000 kilowatts per hour per person in the US. Therefore, to ask Africa to reduce power consumption is non sequitur. That is not to say that Africans cannot cut harmful emissions. We can and we must cut harmful emissions. Why? 4 out of every 5 people in sub-Saharan Africa use firewood, charcoal, or kerosene to cook. These fuels produce black carbon, one of the biggest contributors to climate change after carbon dioxide. They also contribute to more than 500,000 premature deaths every year, as well as stunted growth and increased risk of respiratory infections in children under 5. Sub-Saharan Africa's population's growth currently average of 2.7% annually means these problems from cooking fuel will only get worse until a safer, cleaner option is found. One last key number to remember. Imagine for a moment the carbon emissions from 320 million cars. That's the amount of carbon dioxide absorbed by Africa's tropical and montane forests. Our continent absorbs the equivalent carbon dioxide emissions of all cars in the US and more. Large swaths of our continent actually have a zero or negative carbon footprint. What that means is that Africa is essentially, effectively at net zero. But this situation will not continue if we're going to continue developing, which is why we need to find ways to develop responsibly. Even so, make no mistake, Africa is a significant piece of the global net zero jigsaw. First, we need to ensure that we continue to provide this vital carbon sink by arresting the world's fastest rates of deforestation as people chop trees for firewood to cook with. Essentially, we need to find ways of keeping the trees in the ground. We must provide cleaner fuel as an alternative to people using firewood for cooking. But perhaps an even more significant contribution that Africa can make to global net zero is by massively reducing shipping. If global shipping were a country, it would be the 6th biggest greenhouse gas emitter after China, the US, India, Russia, and Japan. Reducing shipping requires a complete rethink of the way African economies have operated for centuries. This is very important if you consider the amount of natural resources that will be required for the energy transition. The World Bank tells us that we're going to need 500% more minerals and metals for the energy transition. That's 5 times the amount of current mining that's done today. For context, we know that a gas turbine, uses a wind turbine uses 9 to 11 times more minerals and metals than a gas turbine. We also know that an EV car uses 5 to 6 times more minerals and metals than an internal combustion engine car. So clearly, we need to start thinking sustainably, because the idea cannot be that we're shipping all of these minerals and metals to one part of the world and shipping finished goods from that part of the world to the rest of the globe. So several regions in the world are looking at supply chain resilience, and supply chain resilience is very key in addressing carbon reductions. Rather than exporting our natural resources to Asia for processing only to import them as finished goods, as is overwhelmingly the case right now, we need to invest in local processing and build circular economies. And I think not Africa alone, but other regions in the world should also think of that. This includes production and processing of the minerals and metals necessary to achieve global energy transition. Africa has the world's largest reserves of these minerals and metals. Producing the batteries and electric vehicle components locally in Africa will significantly reduce the emissions from global shipping. One manganese mine in Gabon, for example, would honorably ship up to 50 cargoes annually to China. Such voyages can be avoided through local processing and manufacturing. Edging African economies away from primary resource exports towards secondary and tertiary industries is the most effective way to align our continent with the global net zero goals without sacrificing economic growth. In fact, there's no other way. Currently, 70% of African exports are derived from oil, gas, and carbon-intensive mining, contributing half of the continent's gross domestic product and the lion's share of government's income. All of this must change. But how? Africa needs a realistic roadmap that takes a different but effective approach to global net zero. AFC's recently published white paper, Roadmap to Africa's COP, a pragmatic path to net zero, which I believe the organizers of this webinar are now posting in the chat box. And I'll also send you a copy after the call. Actually, I advise you and encourage you to go to our website and download the paper. The report, which you will note in the introduction, has been endorsed widely by Africa's leaders, is aimed at building a consensus around a common narrative for African engagement with the world at COP27. Our paper sets out ways in which Africa can balance the need for emissions reduction with trickle development imperative by focusing on 3 significant areas of change. First, localizing manufacturing, as we have discussed. Secondly, building infrastructure for climate resilience, as Africa faces the harshest effects of global warming. And thirdly, leveraging financial innovation for Africa to access essential climate funds. Given the focus of this webinar, I would like to concentrate my attention on this aspect now. Africa, as already discussed, with its carbon sinks and wealth of transition metals and minerals, offers significant solutions in the journey to net zero. But the key to unlock these solutions, of course, is financing. It is true that Africa has received a large sum of development funding and continues to do so. For its 2023 budget, the US Department of State for Foreign Operations and Related Programs has requested that the Biden administration allocate $7.77 billion in assistance for Africa, in addition to emergency aid. The European Union and its member states are among the largest donors to Africa, contributing approximately 20 billion euros per year in development aid across the world, because all of this is not to Africa. The UK is also a significant donor, recently announcing, for example, humanitarian funding to help people across the Sahel and Lake Chad Basin area. These flows are essentials, but the intervention necessary to move the needle on net zero is not aid, but investment. Repurposing some government aid, for example, first loss guarantees on critical infrastructure projects or insurance to help reduce the risk of private investors could unlock significant amounts of private sector capital for Africa. An investment insurance program which directs aid into a blended credit enhancement product, working alongside the traditional international insurance market, has the potential to double or triple the aid contribution as is currently practiced now. This means that every billion in aid funding can potentially raise an additional 1 billion or 2 billion in private sector capital to develop vital segments of the economy. This is a very important point because we all know that aid is significantly consumed by the administration of the aid itself. So if we say we have an aid budget of 1 billion, what actually gets to people is maybe 200 to 300 million. But by focusing all of that to, or a significant part of that to insurance, we're able to attract even more capital for investments. The importance of governmental and intergovernmental support to crowd in private investment cannot be overstated. Africa captures only a tiny fraction of the 100 trillion of global institutional capital. Private investment flows to Africa account for just 5% of total global FDI, amounting to 3 billion last year. Even in the realm of impact investment, Africa, with the planet's most urgent development needs, was only able to attract 14% of a $500 billion pot based on latest data for 2018. The difficulty of attracting private capital to Africa centers, rightly or wrongly, on investor perception of higher risk. In fact, the perception is entirely wrong. A study by Moody's shows that Africa actually has one of the lowest project finance default rates of any region in the world, lower than North America, Western Europe, Latin America, and Asia Pacific. Only the Middle East has a lower default rate than Africa. Even so, African projects face higher costs to raise capital in international markets, the so-called Africa prejudice premium. And let's face facts, the premium is not about to despair given the current risk-off sentiment for emerging and frontier markets. AFC's many projects over the course of our 15 years have demonstrated that it is possible to mobilize financing at scale through crowding in private sector investment. By leveraging financial input from governments and NGOs, we have the tools to de-risk climate investments and offer strong returns, to incentivize funding from institutional investors such as pension funds, sovereign wealth funds, and insurance companies. Some of the tried and tested financial innovations include public-private partnerships, blended finance, B-loans, green bonds, first loss equity, insurance, and guarantees. With financial institutions having pledged at COP26 to align portfolios worth 130 trillion to achieve net zero, dedicated funding is limited only by our ability to innovate. Thank you very much. Thanks for your attention.
Thank you very much, Sumaila, for that enlightening and interesting remarks and start to our webinar. I am very grateful that you could find the time in this busy lead up to COP27. So thank you very much. I would now like to hand over to Nazmira Mula. Nazmira is Chief Sustainability Officer at 91, and Nazmira will be in the chair today for our panel discussion. And just a reminder to everybody, if you have any questions, do pop them in the chat and we'll pick them up and deal with them at the end of the session. Nazmira, over to you. Thank you.
Thank you, Karen. I think that our opening two speakers, Mark and Sumaila, have both outlined the challenges that Africa faces in this global race to net zero. Africa has low current levels of emissions, massive requirements for development, and how we marry those two things over the course of the next 5 years, 10 years, 20 years is going to be critical to developing the continent, achieving economic and political stability, but also in terms of supporting the global movement towards net zero. Because unless Africa manages to develop in a way that's aligned to net zero, we're not going to be achieving that as a globe. So in order to discuss the challenges Africa faces and some of the difficult decisions and trade-offs we are going to have to manage, we have a fantastic panel to help us think through this. So firstly, James Mwangi is an executive director at the Dalberg Group. Dalberg works with countries to develop projects that support inclusive growth. Great example of a recent project of theirs is a facility they've helped develop with the AFDB to scale renewable energy providers. Mohan Kanandan is head of origination and coverage at the Development Bank of South Africa. He has over 20 years experience in the African finance space. Astrid Manroth is Vice President of Emerging Market Power at Shell. She has over 20 years of global sustainable energy finance in both the public and the private space, and also in academia. So a wide variety of experience. Actually, we have a couple of people on this panel who've ventured into academia for periods. Moan, I noticed on your CV also there was a period in academia there. Rachel Antwi is the group head of sustainability at EcoBank with over 15 years of experience in the banking space in Africa. As Karen mentioned, I'm Nazmira Muller from 91, Chief Sustainability Officer. My background is originally as an economist and then in the debt and infrastructure financing space. So with the introductions done, let's dive right into the subject matter. And I'm going to start with something that is quite contentious, I think, but critical as we think through this. I think one is that's being publicly aired around the African transition is how do we deal with energy access, but also how do we deal with gas in the African context. So James, let's start with energy access. Renewables are being developed quite rapidly across the continent. 91 through the Emerging Africa Infrastructure Fund has been very involved in financing a lot of this. And we've seen many institutions step up, particularly development finance institutions, to provide this sort of financing. But I think the question is, are renewables enough to provide the energy needed? And how do we think about that in terms of Africa's energy mix?
Thank you, Nazmira, and thank you to Invest Africa for convening this conversation. I think I'll draw a lot from the prior conversation in my answer to yours. I think, are renewables enough? I think it will depend on where you are. Yesterday, I spent most of yesterday at a place called in Lake Turkana, and Lake Turkana is in the north of Kenya. And to give you a picture of the place, you have the Lake Turkana Wind Project, Africa's largest terrestrial wind project, one of the best terrestrial wind projects in the world. Those of you who understand, a project that's generating capacity factors in excess of 60%. That's almost base load quality wind. That's sitting right next to about 2 gigawatts of undeveloped geothermal power, and geothermal, which is the mainstay of Kenya's power system and is available all the way up and down the Rift Valley, is also baseload quality. And that is also, for anyone who knows Northern Kenya, sitting in one of the driest, sunniest places in the world, where almost none of that solar potential is currently being used. Taken together, I looked around and I could see just within eyeshot, something like between 5 and 10 gigawatts of energy potential that is currently largely untapped. And that's in one location, in one corner of one country. Now, is that enough? For some countries that do have baseload quality resources, I think the answer is an emphatic yes. And indeed, that presents an opportunity, because if you can offer, as a country like Kenya can, 90% plus green energy dispatched on its grid, that's not just something that's good for your country. It becomes a competitive and comparative advantage in terms of attracting industry, and to Samela's point, essentially offering to decarbonize the world. Other countries may not be that lucky, and in those countries, some use of gas for baseload will be needed. But I do think that we need to think in full context. When we talk about energy access, what are we talking about? There's energy for industry, and their baseload for the grid is critical. There is also energy for individual productive use. And there, Africa's main struggle hasn't been supplying power necessarily just to our urban centers and so on. It's been to the majority of our population who do not have a grid connection. And there, again, renewable solutions, particularly off-grid solar plus storage, end up being potentially one of the fastest ways to actually reach everybody cost effectively, as we try and roll out the grid on a more sustained basis. So the answer is yes, there will be places where using Africa's gas to supply baseload electricity makes a lot of sense. However, particularly for countries that do not have their own gas and do not have secured access to it, or for countries with vast amounts of untapped renewable energy, we need to actually take the energy question first and treat the use of gas as a subset. If I could make one last point, we need to note gas, like other oil and gas products, is a globally traded commodity. Its price moves with the world price, whether you have onshore supply or not. If we're thinking about energy security and economic stability, there's another argument for doing as much of each country's energy system on renewables as possible, which is it limits the amount of inflation and economic disruption transmitted by variations in global commodity prices, as we are seeing with the Russia-Ukraine crisis today. Over.
James, you put a couple of concepts down there. I mean, I think underlying all of them is the fact that renewables have increasingly become our least cost option at the starting point. Whether or not the resource is fit for baseload, whether or not we can add storage becomes secondary questions, but the starting point is this is our least cost option at the moment. So on that, Mohan, James has already introduced the concept of gas. So let's go into that before we tap into this idea of storage versus gas. I know you have some pretty clear views on Africa and how gas should be brought into the mix.
Thanks, Nithmira, and thanks also for my friend James for introducing the topics. I think, from the DBSA's perspective, our mandate is to promote sustainable infrastructure on the African continent, and we work throughout sub-Saharan Africa. And James is right, every country does have its differences, but for me, it's a pretty clear answer, which is renewables by themselves is not enough. Absolutely, we should be investing as much as possible in renewables. And certainly, we do that, and we work with a lot of our funding partners in doing so as well. But, what we realize is you do need a mix, and in a number of countries, gas is going to be the right answer, certainly in the midterm. Maybe, 2030 onwards, that may change with, advances in green hydrogen, with improvements in storage. But for the time being, I think we do need that. So what we're seeing is, we're looking at it as a mixed opportunity, invest as much as possible in bringing in, various types of renewables and, bringing between solar, wind. Obviously, we also invest a lot in hydro projects. They do take a number of years to come through, but, we funded projects on the Zambezi River, in Gabon, in Senegal as well. So that's another area where, there are African countries where we want to bring in hydro as well, also in Angola. So it is a mix. But our feeling is the continent definitely does need to take advantage of the resources that we have in order to drive energy access, because ultimately that's the key issue, is to ensure that there is access to energy at a reasonable cost and on a consistent basis, both for households and for industry to flourish. Because the reality is, if we don't do that, then people will make alternative arrangements, as the AFC CEO has mentioned, which is there's going to be significant deforestation that will take place on the continent if we don't provide alternative opportunities for people on the continent.
Okay, so some role of gas, but even in your framing, it sounds like the role of gas as baseload has a limited time. So we shouldn't, I think our view is very much that we shouldn't be looking to build baseload gas for the long term at this point. If you're building gas baseload for a short period and then should be able to shift into peaking. Does that
I think
largely make
short
sense?
term, it's a question of the number of years, right? So, we're looking at least 8 years plus. And then I think what is interesting in terms of a lot of the gas infrastructure for funding, we're already moving away from heavy fuel oil towards the use of gas and often indigenous gas resources. Down the line, that infrastructure could possibly be used to bring in green hydrogen as well. It may not be 100% green hydrogen. I know there's a number of tests being used already to bring in the portion of hydrogen to mix with gas to reduce the carbon intensity of the power being generated. So I don't see it as being a stranded asset if in the future there are advances in other such technologies.
Okay, so I think
if I'm
go for it, James.
Sorry, if I may, I do think there's a critical point here, and Nazmira, you were already alluding to it, but I did want to emphasize it a fair bit, which is if we buy the fact that it takes several years to roll out these infrastructure projects, then 2030 is actually not far away. We're talking about, for any new gas infrastructure you're putting in, suddenly it's on a clock of 4 or 5 years before it is not necessarily the least cost option, and before it potentially becomes an anchor in terms of not just its carbon intensity, but its price on the rest of the economy, unless very carefully priced. And there, I think designing from the beginning with an eye to the green hydrogen revolution is the key, is basically saying build infrastructure that is resilient to that shift from the beginning, and indeed is leading that shift, because some analysis says Africa is very well positioned to be a green hydrogen giant. We are relatively under-endowed in fossil fuels per capita versus other parts of the world. But green hydrogen could indeed be an area where, as its price comes down, it's a net win for Africa, unless we tie ourselves too much to legacy fuels at exactly the moment when our emerging advantage in some of the fuels of the future comes into play.
Sounds a bit like South Africa deciding to build Medupi and Kusile right at the end of the coal-fired power boom. So exactly, we don't want to be repeating those mistakes at this point. So roll for gas, but resilient infrastructure. I love that term. Astrid, let me bring you in here, because it does seem like technology has to be a big part of the solution here in terms of building resilient infrastructure, being more creative as we think of energy provision in the continent. How are you thinking about that?
Thank you very much, Nazmira, and thank you for having me as part of this very important conversation. So, Shell's Powering Progress strategy includes both a commitment to net zero, but also to powering lives. And under our Powering Lives strategic pillar, the company has undertaken to make a sizable commitment to energy access in emerging markets. And we believe that that really entails harnessing all the resources and technology solutions that countries have. And as was pointed out before, there is quite a variety in endowments, but Africa has very strong renewable endowments in certain areas with advantageous solar and wind resources, but also significant hydro resources in other regions. So we think about in emerging markets power really, about boosting Africa's generation capacity, but at the same time also powering lives and connecting people. And that brings interesting opportunities on technologies, both on the grid and off the grid. And perhaps I think it's worth focusing particularly on off-grid discussions, because that's such a unique opportunity for Africa as a continent, where over 60 million people today already are served through on-grid solutions, and where we know the grid is only covering on average 50% of the population, and consistent underinvestment is not going to change that radically overnight. So we really quite strongly believe in the opportunities of renewables off-grid solution, both for the B2B customers and the B2C customers. We just bought very recently Daystar Power, which is a West African rooftop solar provider for commercial and industrial clients. And if you look at a country like Nigeria, which is basically running on generators, providing these solar rooftop solutions, a standalone for power as a service solutions, but also possibly in conjunction with domestic gas resources for 24/7 power as a service solutions, really is quite competitive for these industries and is aligned with a pathway towards net zero, because you are replacing expensive and polluting diesel generators. And then similarly, as was already mentioned earlier, for the last mile energy access, solar home systems have proven to be a financially sustainable and quite affordable ways of connecting people with immediate impacts on education and health and others. And there are a number of companies that Shell has also invested in that are getting to scale in this business, which is extremely encouraging. In a way, Africa there can really leapfrog. Mini grids, decentralized mini grids, of course, can be part of the solution as well. there it's very important to find a good balance between commercial and residential customers to also ensure the affordability for the last mile access. And as was said, new technologies are on the horizon, but at the moment, of course, are not yet at a commercial stage. So we are very excited about Africa's energy transition and the opportunities it provides, both for the net zero pathway, but also for powering people's lives.
So Astrid, a lot of what you're saying speaks to the needs of the continent. A lot of it is about providing energy where it isn't there. I mean, if you compare what you're seeing in Africa versus what Shell's seeing in Asia, for example, what are the key differences?
Good question. Well, again, from the energy access perspective, and that's really my team's mandate, one of the key differences is that there is a significant larger off-grid market in Africa, which also brings opportunities. If you compare key energy transition countries in Africa, like Nigeria with India, that's a key difference there. And then, of course, another big difference, it's a lot about first-time access still in Africa, whereas in Asia, it's perhaps more about improving reliability of existing access mechanisms. And then, as was already pointed out, resource endowments, of course, differ as well. Regulatory frameworks, on average, are more developed, I would say, in Southeast Asia than they are in Africa, while there are very good advances also in certain African markets, whether that's in South Africa through the recent 100 megawatt limit for captive power, which is a tremendous opportunity, or in Nigeria with the franchising regulation that also allows partnering with distribution utilities, which can be another very meaningful way of reaching the last mile access. But there are also, good experiences in India and Southeast Asia where Africa can learn from. So I think it's both a difference and a complementarity.
Okay. And I think that that off-grid component is something that we're seeing develop quite interestingly in a number of countries. Shall we talk a little bit about South Africa for a moment? Because I think that's the one country where decarbonisation is really important for the continent. And Astrid, you've mentioned the change in regulation. I mean, what are you seeing in that market that is making you excited? I mean, I can tell you what we're seeing is a lot of the mining companies in particular talking about doing a lot more of either self-generation, mostly some on-site, but a lot of it elsewhere, and trying to wheel through the grid, which is a challenge in itself. But also we're starting to see companies talking about generating the sale onto the grid.
Yeah, I mean, we are excited about the opportunities in South Africa. It is, of course, Africa's most advanced markets on renewable, and the government has done a really good job through the various rounds of the renewable energy IPP tenders, but also being quite pragmatic about the limitations of the grid and the need to access power through other mechanisms. So from our perspective, it's a high growth market. It is, according to studies from Woodmac and others, accounting for over half of Africa's C&I market, for example, which is the fastest growing segment of Africa's power sector. And we see, many opportunities. I think it's an interesting space to watch from the C&I perspective, because you will have the solar rooftop providers, of course, rushing into this to serve the market, while you also have a number of utility scale developers who have the capacity to provide power solutions to the larger customers, including mines that you mentioned. And it will be interesting to watch who serves with which market. I think there's space for all, but the winning model will have to be developed. And I'm sure Mohan has additional insights, as he's based in South Africa.
I was about to go there. So Mohan, what are you seeing?
Yeah, I mean, absolutely. About 40% of our investments every year are in the energy sector, and the majority of that here in South Africa. What we're seeing is definitely now, with the cap lifted in the amount of, private power that can be produced and sold, that business is really taking off. We just concluded a 200 megawatt solar project where the power was being produced in one part of the country and then being distributed to a mineral sands off-taker in 5 of their different sites, using the existing transmission network. And that's, that was about a 4.5 billion Rand project. So in dollar terms, maybe about $250 million or so. And there's a number of those types of projects that are coming through. So I think previously we'd been reliant on what were these bid windows run for purchase by Eskom, the power utility. But now, we're seeing a significant shift. And what's interesting even beyond that is I think the new model for electricity is starting to develop in South Africa, where there's a lot of new players that are coming in that are becoming electric, almost sort of middlemen of sorts, where they're purchasing, power from new renewable providers, and then having relationships with even mid-sized and smaller corporates with shorter term tenants. So instead of the traditional 15 to 20 year power purchase agreements, they're having a lot of 3 to 7 year offtakes. And one of the challenges for us as funders is going to be to get our heads around how do you provide long tenor funding of 15 to 20 years without that similar long tenor offtake in place. And so getting comfort with what we call the merchant market is going to be very, very important. It's already happening in South Africa. That's also happening within Southern Africa as well, with the emergence of the Southern African Power Pool as a trader. People are trying to do merchant markets there. I think there's a very big role for financiers, especially development financiers, to step in and provide guarantees to enable those projects and those types of entities to really take off. Because once that happens and everybody gets comfortable with that model, it'll become business as usual. But that's going to take probably about 3 to 5 years to get there.
So partial guarantees for merchant providers in the renewable space.
And also, liquidity facilities as well, so that if there are delays that, we can step in and provide. I think in the longer term, it'll be okay, but you may need, 6-month type liquidity availability type guarantees as well. I know the African Development Bank and the World Bank have done that. I think a lot of us have to start thinking along those lines as well.
The reason I honed in on that point is I was at a conference Standard Bank had last week, and we had one of their bankers, and the question I had to him was, have they gotten brave enough to finance projects where only 50% of the offtake is contracted? And after much squirming, the answer was still no.
Yeah, no, I think we would be comfortable if there was enough. So even if it's not 100%, if we can at least get around that 50-60% of the offtake in place, I think we can take that risk. The challenge is to go where there's zero offtake in place. I think that's probably a bridge too far.
James has got a more challenging question for you, I think.
No, it is not necessarily a challenging question, because I love the work Mohan is describing and the direction of travel. I think it's to call out the fact that we still tend to think about demand and supply in Africa as a closed system. And so the big issue in a lot of countries, so in South Africa in particular, that it makes sense from a climate perspective, because there's a massive amount of decarbonization and greening of the energy supply that needs to happen in addition to additional energy. That's fantastic. For much of Africa, our poverty is manifest in the fact that we're using so little electricity. They're just two ways of saying the same thing. That these countries are poor because they have little industry and they have little power. It's a circular problem. And if we keep coming back to, whenever we look at countries with a lot of untapped energy, sometimes high quality renewable energy, the issue is, well, where is the demand? The real speed limit is the demand. And I do think that when thinking about energy in Africa, as much time needs to be going towards making the case for shifting global energy intensive activity to Africa's untapped renewable or greener energy grids, as is spent on, well, how do we somehow figure out a way to finance based on the limited local demand that is possible. Unless we bring demand recruitment and demand mobilization into the tent, we'll be optimizing in a very small base, whereas what we actually need to do is be making a quantum leap. To Samela's point, if we're moving mineral processing on continent, if we're arguing for massive amounts of green hydrogen, a lot of other energy intensive industries such as data processing and so on, we need to actually have that discussion and investments in those industries hand in hand with the energy system discussion. Otherwise, the big industries won't come because the energy isn't there or is too expensive, and the energy won't be built because the industries haven't come.
Okay, It does strike me that the two industries you cited are the most obvious ones to start with on that point, which is mineral beneficiation, since that's one step evolved from digging it out the ground. And the second is green hydrogen. But both of those require fairly large quantums of stable electricity. Running smelters or running electrolyzers require large quantities of stable electricity. So you sort of back to where we started the conversation, which is how do we ensure sufficient base load in the short term to do that?
And I think that's the chicken or egg issue, right? We need to ensure that the continent has that energy, because otherwise, private investors are not going to come in. So, that's, I think our role as development financiers, the AFC, the DBSA, and a number of others is to work with the private sector to ensure that that energy is available, whether it comes from renewables, whether it comes from gas, whether it comes from hydro and other, maybe geothermal, right? We need to ensure that it's there to help drive industrialization on the continent. Another area is agro-processing. Not enough agro-processing takes place on the continent, but elements of it is also energy intensive. So we need to ensure that's there. And then I think the investors will come in and deploy it and utilize the energy.
Well, what we are seeing, though, if we take green hydrogen in particular as an early example, is we are seeing the energy development being taken as endogenous to the projects. If you look at what's being discussed in Chile, in Morocco, in Egypt, it is actually saying build the renewables to do the hydrogen and treat them as a single project rather than separate project. And I do think that leaning into those types of spaces where you can go fast, and like I said before, there are places on the continent where there are large amounts of untapped baseload renewables as well, where the hook becomes, and this is where I do think we need to also actively market the continent as a green manufacturing destination. So we're saying, not only are we able to tap renewables, but it's a competitive and comparative advantage driver. But again, I come back to how do we think about, for example, green hydrogen as one of those entryways where we're saying these projects are developed with the energy supply included, and that allows us to get the energy system growth underway or accelerated a little bit faster. Because the use case is not, well, maybe domestic demand will come. It's that you've got your big industrial buyer already underwriting the expansion, as has happened everywhere where green hydrogen projects are getting underway right now.
Okay. I think that makes complete sense, is this idea that your funding is built into the industrial project. Funding for renewables is built into that as well. Shall we talk a little bit about grids? Because to some extent, the idea of having baseload renewables is dependent around your ability to transmit that power within country and perhaps within region. So when we think about grids within country, they often are inadequate, whether that is in South Africa or Mozambique or Kenya. So how do we start to solve the grid problem and financing grid expansion? Gents?
Maybe let me get started. And then, because it is an issue as the DBSA we've been tackling. Certainly within South Africa, we do need to, to increase the capacity of the grid. One, to reach out further into areas where there are competitive advantages around renewable energy where the grid doesn't exist. That's an easier solution because you can build that in as part of a specific power purchase agreement to add in the cost of the grid expansion. It's a bigger issue when you're talking about the grid within the country itself and to have to increase the capacity of it. And I think at least here, the government's able to, and it is looking at recapitalizing, the utility, splitting up the transmission side and allowing it then to have its own, financing mechanism. I think elsewhere, though, it's a much bigger challenge. We're going to have to figure out ways of how to try and bring in private investments. One of the things we're looking at now within the Southern African Power Pool is to find ways to fund transmission network expansion using offtake agreements. So traditionally, it had been done, for instance, from northern Mozambique and the Zambezi River in Zambia through to South Africa, with South Africa acting as the offtaker, which funded that transmission grid. But I think there are some mechanisms to put together a regional financing facility as well, and charging, per electron that goes through the transmission network and using that. But it's still in its infancy, and we haven't gotten it right, because traditionally you relied on the utilities to be able to fund that transmission grid expansion. And unfortunately, the vast majority of the utilities are not, don't have that the balance sheet to be able to do that.
Okay, so we're back to James's point about include the cost of financing, not only of the renewables, but also of the grid connection into the projects where necessary. Astrid, in terms of your experience, how have you seen the grid solution being dealt with? And are there technologies we can use in order to better deal with this?
Yeah, it's a good question, Asmira. From the Shell side at the moment, we still find immediate private sector investment into larger transmission grids in Africa to be somewhat difficult, but the potential financial solutions Mohan just mentioned sound interesting. So for the moment, we are more focusing on potentially more local or opportunities under sub-franchisee regulations in places like Nigeria or India also, where we could partner with discoms, possibly through dedicated distributed generation into their regional grids. But I think on the transmission side of things, to get there at scale, we still need help from the public sector for larger scale private sector investments.
Public sector, you mean African public sector, or you mean actually concessional, perhaps even some measure of grant financing from the developed world as well?
Yeah, anything that de-risks partial risk guarantees to the extent possible, but also then additional concessional finance, so that it becomes investable for a commercial investor like ourselves.
So I think, why don't we've sort of touched on the need for financing and minimum requirements for financing along the discussion, but maybe we shift into talking about capital mobilization. Mr. Zabaro earlier on mentioned the massive financing needs required for the infrastructure investment, particularly in the power sector in Africa, but actually mobilizing that capital often gets stuck in the big numbers. So instead of doing that, instead of chucking out the $250 billion a year Africa needs to meet nationally determined contributions, let's rather focus on some of the areas where we think can be funded entirely commercially at this point in time. So I'm taking input from everyone on the call. Rachel, I think, is still having connection problems, but for Astrid, Mohan, and James. So what are the areas that you're seeing where financing is relatively easy to get done? I'm not suggesting it's absolute easy. We all know project finance or infrastructure finance is never easy, but on a relative basis, areas that you do not see the need for partial guarantees for risk mitigation at this point.
If I just give some very concrete examples in South Africa now, where effectively, I don't think there is any kind of guarantees needed for the CNI market. It's already happening and it's shown in the fact that you can get 20-year tenor fund, and you're being able to do it without a tail, meaning where the power purchase agreement length is the same as the length of the debt, and you can get, and if you look at the pricing of that senior debt, in a lot of cases, you're getting pricing that's lower than the sovereign's borrowing. So, in South Africa. So it shows you the fact that certainly there is a wall of capital that's being deployed now in South Africa into the space. I think—
And Mohan, that's for a project where the offtake is a corporate. So there's no sovereign guarantee, there's no guarantee on the power purchase agreement from the sovereign on this. It's simply just a corporate offtake.
It's simply a corporate. And where it's moving to, as I was saying, is you've got new companies that are starting where they are looking and they're being funded by private investors, where they're able to establish renewable energy projects, and they're going to feed into specific, not even the large mining industrial offtake, but smaller sized ones, where and they're willing to do it, as I said, in shorter tenor, so 3-5 year agreements, because a lot of industry and a lot of companies don't want to be tied down for 15 to 20 years, but they are comfortable giving a 3 to 5 year agreement, which is more aligned to other supply agreements that they would have in place. So, and that also is an area where it's to be tested, but I think we're very close to that in South Africa, where that market is also going to happen without even necessarily the need for development players, even though, you know, we would be happy as a development bank to support that sector. The challenge then is, as you connect Southern Africa more strongly, then if you, for instance, build a renewable project in another country, but you're connected, you know, you can always then sell into the South African market if the market doesn't come through as envisioned in a Zambia or a Zimbabwe or a Mozambique. So that interconnectivity just gives you a bigger pool of clients to work with, which makes your project now, you know, significantly more bankable.
I see Samela has his hand up.
I wanted to give an example of what we've done in Djibouti. So in Djibouti, what we did was we built a 60 megawatt wind farm, you know, and we did that essentially with private capital. It was ourselves, FMO, and Climate Investor One. And what we did there was unique in that we tried to avoid the delays in raising project finance by employing what we call construction finance, which is we're constructing the asset. We've actually almost finished. We're going to commission before the end of the year. And then only after the commissioning will we raise debt. So it's a way of ensuring that you deliver a de-risked project. You know, so that's an example, you know, of what we've done. And we found that we actually did the first pilot in Côte d'Ivoire, there for a hydro dam as well, where we're using all equity to do the construction. And after the construction is done, then we raise project finance debt. At that time, we're offering cash flows that can be diligence, you know, as the basis for the debt, as opposed to the construction risk, completion risk, and all of that, which is really what we try to do. All across Africa, we develop to de-risk opportunities. So that's an example of using private capital to do renewable projects at scale. You know, and with our recent acquisition of Lekila, where we have a large pipeline of up to 3 gigawatts, we are also trying to do the same. You know, looking at specific markets, new markets. I think the trick here is in the size of the projects. You know, if you find right size projects as opposed to trying to do this on 1 gigawatt or 2 gigawatts, then you have a challenge. But if you're looking at well-sized projects, then you're able to execute and scale up as you go along.
And well-sized projects, well, what's the sweet spot for you?
50 to 100.
Okay.
You know, I mean, if you go on to 200, it's possible, but 50 to 100 is always easy for you to do the construction finance, you know, on that scale.
Okay. No, I think that's been our experience. Rachel, so lovely to have you join us. You've got your hand up.
Yes, thank you very much. My apologies, I'm struggling with my internet, unfortunately. So I'm accessing via my phone. So please allow my video to be off, if it is okay. I just wanted to add on to what is being said in terms of the finance. Now, I've also seen that there is a growth also in the capital markets from the sustainable or green finance aspect as well. For example, in EcoBank, we were able to raise about 350 million of sustainable finance, which was used to finance some project finance adaptation projects, which is for, you know, some in infrastructure, such as dams and the rest of it. So I think that a development of Africa's capital markets will also help to sort of bridge some of the funding gap to fund some of these projects that we really need. And that also comes to maybe creating, another point I also want to raise is that there is a need to create a sustainable finance platform in Africa that promotes sustainable investments and finance generally. Something outside a developed market like South Africa, probably in the middle markets, in middle Africa somewhere, that works with the government, helps to inform policy, conducts research, help governments in developing products really from the initial stages to ensure that they're bankable for the private sector to be able to invest in. I found that there is a specific gap to develop this kind of platform and to develop a market, because there is capital, there is investor interest, but there is also the perception of the risk and the underdevelopment of these markets, as well as the policy and technical constraints that is hampering the growth in this area.
So I think that development of the local capital markets is an important area that we need to think about, and how that starts getting drawn into it. James, what are the areas where you do need concessional finance and you need de-risking? So the grid is clearly one of them. I mean, Astrid made that point very clearly in her discussion earlier on. But from what you're seeing, where can the use of either junior tranches or guarantees have the most benefit in this in this energy build out that we're talking about?
I think one obvious area is in trying to reach the majority of the continent's population, trying to reach and serve the majority of the continent's population that either have no or functionally no access to electricity today. The economics of African grids right now, we're combining the massive cost of actually building out energy access to poor and unconnected communities with the business of serving competitive industrial consumers of energy. And as a result, many of our utilities, yes, there's mismanagement, yes, there's a whole set of other issues, but they're trying to combine two actually very different sets of risks and challenges. And as a result, they all just sink under the weight. And I do think that the more that we can tease out the energy access mandate, which actually makes a lot of sense for concessional finance of different kinds to really lean into and say, this is really about reaching those 500 million households that have nothing or very little. And whether you're doing it off-grid, mini-grid, or by a grid reticulation, you're actually financing that separately, or even financing the generation for that somewhat separately. That might allow for then the more competitive and commercial side to work better, be more dynamic, and grow faster. It's the blending that actually creates, even with the highest quality management and clearest strategy possible, it just creates a real tough challenge, because a lot of that build out takes a really long time to become commercially viable, because by definition, these are places where, and these are consumers for whom electricity will be transformative immediately, but will not be generating income from day one, because it needs to be fully integrated into the fabric of where they are.
Okay, I mean, I think that that's the really important point that underpins a lot of this. Astrid, is there anything you want to add on this in terms of mobilizing capital, either in terms of the pure commercial? I mean, your earlier points around the grid needing public sector financing are important and noted, but I mean, on either side, as Africa looks to mobilize capital in order to meet its energy needs, but also its transition requirements, are there any particular projects or things that you think we should bear in mind?
Thanks, Nazmira. Maybe a couple of principles. I mean, there are certain segments of the power sector that are commercially viable, right? And I mean, those I think should really be left to function as markets. And for me, they include, particularly on the off-grid side, solar home systems, but also the CNI space. I do believe that DFIs should focus their efforts on areas where really de-risking is still needed, and that, yeah, it does include the grid. It does include offtake arrangements from the private sector perspective as well. You know, the majority of on-grid off-takers in Africa are still government-owned entities that are not standalone bankable on average. Of course, certain utilities are better run than others, but from a private investor perspective, that remains a concern. But I also would like to say, maybe in response to James's point earlier, maybe we also have to change our vision a little bit on what the future utility in Africa looks like, because in my mind, it is building or integrating on-grid and off-grid elements, because as James pointed out, it is far too expensive to build the last mile on the grid, but there are good innovations happening off-grid, and with careful planning, you can actually integrate and make sure that you invest and design complementary areas for solar home systems, for mini grids, for distribution utilities, and then invest in the transmission backbone accordingly. And I have not yet heard much about this integrated vision, but for me, that's ultimately the end game where we would like to get to. And maybe it's good to have that North Star in mind.
Okay, so I think with that, shall we look at the questions that have come through? The first one is around gas extraction. So Mohan, maybe you can have a go here. So it's actually, what is the evidence that gas extraction is actually helping energy access? I can see that gas may be needed to power development until green hydrogen or other renewables come on stream, but is gas today improving energy access as fast as is needed?
Yeah, I mean, look, I think it's a pretty obvious yes. It's clearly working. There's a number of countries on the continent that have significant gas deposits, and we are utilizing those gas deposits to put in place gas-fired power plants, which are, which is increasing the amount of power going into the grid, which supports industry, which needs that type of power, but also households as well that are connected to the grid. Obviously, it's not a 100% solution, or there will be needs for off-grid solutions as well. But, we've been involved in projects in Ghana, in Senegal, we're looking at a project now in Gabon as well, where we're looking at using the gas power that's available, to help drive industrial growth. And it's absolutely needed. And, we can talk about newer technologies, but the reality is, there are over 600 million Africans today who need power. So we can't talk about something like green hydrogen. Yes, we should be investing in improving it, but it may be viable by 2030. It's not guaranteed, right? So that is the challenge. We have to solve for the problems as we see them today, and we have to be strong enough to take on the entrenched lobbies that in some cases, unfortunately want to keep Africans in poverty. So yes, we will follow the technology and invest in everything that makes sense, but we need to be unapologetic as well. And what I'm very happy about is that the African Union has taken a very strong position on the matter, and they've called on African financiers, both developmental and private, to support, industrial development in the continent, including the use of oil and gas resources, both for domestic use and in cases for exports as well, because that's the other element, right? I think almost all of this technology right now is being imported. The Lake Turkana project that James was talking about, what was the amount of FX that was needed by Kenya that, to import in all the wind turbines and everything else that went into that project? Where is Kenya going to get the FX to do that? Now, a lot of African countries, some of the obvious source of FX for them, foreign exchange, to manage balance of payments is through the exports of oil and gas products. And so what we may see is this sort of a trend where there may be an increase for the next many years of greenhouse gas emissions. And then over time, you can see those countries then managing their mitigation efforts as well. There are other countries like South Africa, which may be a little bit further advanced along it. But we cannot keep African countries in energy poverty and also say you must keep all of your oil and gas resources in the ground for the benefit of other countries which are not doing that. I mean, I read a ridiculous article just yesterday that said that Germany is tearing down a wind farm to expand a coal plant, or a coal mine. I'm hoping that's just sensationalist, but these are the kinds of articles we read in the African continent, and we say, and you want us to do what? It's we need to be realistic.
Yeah.
James, we're going to add.
Yeah, so I think we should be careful not to conflate two things. And I think my friend Mohan makes a good point, which is if Africa has oil and gas resources, of all the countries in the world that should be exporting them, Africa should get to go first, because frankly, that's just a fiscal benefit. I'm not going to argue against exporting in to serve existing global demand. However, one of the things I'm fond of pointing out is the biggest investors in the world today, some of the biggest per capita investors in the world today in green and renewable infrastructure are countries like Norway, whose grid is almost entirely renewable and whose automobile fleet is almost entirely electric, and the countries of the Gulf. And what they are doing is saying, and your point is correct, that you export whatever you have and you build for what makes sense for you, given your local resources. And I do think that we need to, for all of this, set aside sentiment and emotion, because there's advocacy of different kinds coming from everywhere. It's possible that there's a green lobby somewhere that is as powerful as the largest, most powerful industry in the world for the last 150 years. But it's an open question which side the lobbying is sitting on. We should just ask, when will this be ready? How much useful life will it have? And what assumptions would I need to have about price and or other market dynamics such as carbon pricing and so on throughout the useful life of this project for it to make sense? Otherwise, we may be buying a whole fleet of new Kusiles and Medupis across the continent at a time when we actually are positioned to win the next phase of the energy transition.
So on that, one of the questions that came up was around green hydrogen, and asking the question around what have we learned from some of the other projects that are already taking place around green hydrogen that we should bear in mind as Africa looks to develop it. I mean, is that a question we can answer now, or are most of these projects so early stage that it's difficult to take the learnings as yet?
I mean, I think right now the price of green hydrogen is just way too high for it to be adopted at scale. I think absolutely work on the pilots. Agree countries like South Africa and Namibia are investing significantly in green hydrogen. So it's not that we're not doing it, right? All we're saying is at this stage, it's not a viable technology for mass adoption. It may well be down the line, but you know, we need to act based on the knowledge we have now as well.
I mean, I think what we are hearing, speaking to some companies, is that the Inflation Reduction Act in the US has changed that quite considerably and made hydrogen a very much more attractive investment to consider. Moving on a little bit, we have a question from Ibukan Adebayo from the London Stock Exchange. What does the panel think about the establishment of a carbon price for Africa in relation to eligible mitigation projects across the continent? Rachel?
Thank you. Yes, so South Africa is the only country I know on the continent that has a carbon price, and even that I don't think it's effective globally. I don't think carbon pricing is effective in any way. But on top of that as well, I generally don't have a good feeling about carbon pricing, because if you really look at the economics and seeing that climate change is an economic failure, why are we all required to pay for the emissions of large companies, of global multinationals who just emit CO2 into the atmosphere? Why must I bear the cost of it when these companies can clean it up themselves? So if you look at it from another angle, look at it from Article 6 that's being developed now and the producer pay principle, if we can actually look and hold these companies accountable, they have the technology, they know how to do it using carbon capture and the rest. So I prefer carbon capture as a solution, that can help African countries continue to develop and also use their fossil fuels instead of instituting carbon pricing. I know a lot of economists want carbon pricing, but I don't think it's fair to pass the cost to the consumer that is already suffering. And that's just generally my view.
James, you've got your hand up.
Yeah, so again, I think we need to understand where Africa's interests sit in the question of the carbon markets. And I think something that Samela said that I really agree with is Africa provides a lot of ecological services for the planet that are uncompensated because of our preservation, our relative preservation of our natural resources and so on. We also have the potential to do a lot of work in a range of carbon sequestration activities. Now, part of how that's being financed today is the voluntary carbon markets that are the beginnings of less regulated carbon pricing. But there's also large sums of money moving in more advanced economies between emitters and non-emitters based on their domestic carbon markets. I don't think the goal is necessarily, or I think that, well, it's a nice thing for African countries to have their own nascent carbon market. The real opportunity here is thinking about carbon and indeed kind of negative carbon activity as an export service. It's another area where Africa could be actually generating income from global markets and their demand for carbon removals if we structure correctly. Today, a tiny proportion of the money dedicated by voluntary markets to African conservation and other projects makes its way to Africa because the way that the market is set up allows for these very token activities on the ground to be sold for much more than that. We receive pennies on the dollar for Africa's existing carbon credits that are being sold in voluntary markets. I think really focusing our attention ahead of future, of developments in the compliance markets under Article 6 and so on, putting our attention to how does Africa generate and sell carbon credits for the work we are already doing for the planet is just a missed opportunity. This is not about African consumers paying more, it is about African youth being able to sell their ecological stewardship service as an export service for cold, hard, foreign currency income for the continent. There's a lot more that we could discuss there, but that's the way I would think about the carbon markets. It's less about our markets for emissions here, although we probably should start doing that. It's a lot more about how do we structure African access to global carbon markets early and well to maximize the amount of income that gets to the grassroots on the continent.
And in thinking about that, I mean, you talk about Article 6, but do you think there's a role for the voluntary markets on that? Because I think, as there's a increasing focus on the voluntary markets, the verification mechanisms around that, it does strike me that increasing the stringency on from the voluntary market verifiers to channel those credits into significant providers of carbon mitigation could be a massive potential benefit for Africa 100%. For the reasons you've already outlined.
That's exactly right. In a sense, the market that exists today is the voluntary market, and that is growing rapidly. You've seen substantial increases in the prices of credits, and we need to understand how to engage with it. We also need to recognize that Africa's interest, there's a whole question of whether having the voluntary market alongside the compliance market means double counting. And actually it doesn't, because the voluntary market is a company across its value chain paying to say to its consumers that we are net zero, whereas the compliance market is really around countries saying that they're meeting their NDC targets. And those two things can happen entirely in parallel, because just because it's an American company doesn't mean all of its operations are in America and so on. So that's the first thing. We need to treat those as separate. And we need to recognize the huge opportunity that exists in increasing the stringency and transparency of voluntary markets from a global South perspective. In some work we did, we estimated that Africa today is leaving behind on the table for activity already happening on the continent, something on the order of $2 to $3 billion a year at current carbon prices, and as high as $10 billion a year with predicted increases or projected increases from most reputable estimates over the next 4 or 5 years. This is a major new and very job-intensive industry that actually has ecological benefits, and it involves thinking about how are we selling our credits in the best, most responsible, most competitive way, and attracting private investment into the continent's carbon activity.
So if carbon credits could potentially be a net source of inflows to Africa, an export that we provide, I think it's a service. I'm not sure. I think it's more a service than a good that would be exporting. There's a question on the chat from Hubert Danso asking about the legal and regulatory innovation that's critical to scale and deploy capital at speed. And I mean, I think we all have our long list of what's necessary. But if you can pick one legal and regulatory development, either a principle that you'd like enshrined across most countries, or you can focus on one jurisdiction and something that could make a difference, what would it be? I see Mohan's already taken himself off mute, so he's giving James and Astrid, Rachel a moment to think. So Mohan gets to go first. Yeah.
I mean, yeah, we're very excited because if you just look at within South Africa, where, you know, opening up the power market for private to private purchases, and also, you know, a better view around what the wheeling cost would be, you know, that change alone is leading to significant number of projects that are coming through the pipeline, some of which have gone to financial close, and, you know, and will start construction. So I think if that similar change can happen across the continent, then there's a way to do it where, yes, you may still be reliant on the grid to a degree, but at least you won't be needing to worry about the financial viability of the utility as the off-taker. And you can have, you know, power being purchased by companies and households that need them based on the balance sheets of those entities. And I think that alone would lead to a significant amount of new power coming into the grid in a number of countries.
So opening up grids that exist for wheeling direct from producers to customers. Okay, Astrid?
Yeah, that's of course the million-dollar question, right? But maybe just from the private sector investment perspective, really bankable commercial contracts, really all the regulation that enable those, whether it's you know, bankable PPAs or reliable mini grid regulation, or also, you know, with this new results-based finance mechanisms, transparency and reliability in there, all this can help us scale up commercial investment into the sector. And it's very country specific, so I think it's difficult to go into all the details across markets now.
Okay, but I think you made some excellent points. I mean, one that's particularly close to me is the reliable mini grid regulations. Rachel, you have taken yourself off mute.
Sorry. Yes, no, sorry, struggling a little bit with internet here again. Yes, so I also support that about mini grids, but I also think the development of the pro-consumer market, that will be great to allow consumers also to be able to sell their, you know, excess energy to other organizations, and all of that will also help to, you know, drive market innovation and also increase revenue for, you know, for the industry, for people generally. So that's one thing that I would like to see more development on, and increase of regulation on to allow that, especially in other developing countries. Yeah.
Okay, great. And I suppose one of the possible manifestations of that would be feed-in tariffs. James.
So the challenge of going last after a lot of brilliant people is all the best bits have been picked off the bone. I was actually about to say feed-in tariffs even at the domestic level, and okay, that's gone.
No, go for it. I mean,
no, I agree. What I will add, and it's just because it's now suddenly very much on the top of my mind, and it's off topic for this question a little bit, because I think on this one I agree with everything that's been said, is on the carbon side, is we really need to not just value protection. So today you earn carbon credits if your country is actively cutting down its forests. And if your country doesn't have a deforestation problem, then people say, well, that's fine. Thank you very much. We take that as a global benefit for free. Good luck to you. And I think a fight that Gabon in particular is leading to say, actually recognize the countries that have really, and the communities that are really excelled at actually protecting natural resources. And it's not just forests, savannas, there's a whole set of natural resources that have economic value. So how do we move from essentially a ransom-based model that says the world pays when, like Brazil, you're actively cutting down, and move to something that says these are recognized public goods that are valued both in terms of the stocks of carbon that are being protected, but then also the massive flows of carbon that are annually realized. I misspoke earlier, just to give a sense of I checked my numbers. At $10 a ton, Africa today is leaving about $5.5 billion on a year on the table. At $20 a ton, which is where a lot of current carbon contracts are closing in the voluntary markets, that number, because it's not linear, more things become viable to do as the number goes up. That number gets to $13 billion a year today, with no new technologies, no innovation. That's how much we're leaving on the table. Several tens of millions of jobs in the nature-based space. So that to me is another area where having a clarity of what the market opportunity is, and this pure regulatory shift from a ransom-based view to a public good view of preserving natural sinks could actually generate immediate and investable opportunities across the continent.
So on that note, James, I think that you may have felt that it was difficult to go last, but it was a good last one. So let me sum up a little bit, because I think we just beyond time. So firstly, let me thank our panel. Let me thank the opening speakers, Mark and Samela, for setting the scene, and panel for a very active, involved discussion. And I think the key points that I've taken out of this discussion today is, firstly, as we think about net zero in Africa, it is considerably different to how we would think about it in the rest of the world, because energy access, this first time energy access point, is really important. And that has many flow-throughs from that. But even with that in mind, we need to be careful as we think about the role of gas in Africa. It has a role. I think the comfort on the panel was more that it was easy to justify the export of gas, but tying Africa to long-term gas baseload infrastructure was something I think there was a general skepticism of. There's a role for it in the shorter term, there's a role for it at peaking, but we don't want to repeat the mistakes of Medupi and Kusile in South Africa. So what we want is resilient infrastructure. There are a couple of James's phrases I'm going to use in my sum up. The first was resilient infrastructure, which I liked in terms of thinking of infrastructure you build for gas that can be converted into green hydrogen or other uses in the future. The other thought is, as we build projects now and we look at exporting green energy through industrial uses, is to build the energy and the grid connection into the project costs. And as we develop that, whether that is in green hydrogen or whether that is in mineral beneficiation. And then this point that we've just been discussing is how to better use the natural resource of Africa to treat the carbon mitigation from there as an export. And then lastly is, what are the changes we need in legal frameworks? And where it all gets to is making it easier for the private sector to get involved in this whole space. Opening up the grids to the private sector, ensuring certainty on wheeling charges, mini grid regulations, feed-in tariffs, Rachel's point on allowing consumers to input. It is around these areas. And this is how we have Africa industrialized, but also in a way that is consistent with net zero. So on that thought, are there any last comments from anyone on the panel before I hand back to Karen? Karen, I think it's all yours.
Thank you very much, Nazmira, and thank you very much to the panel. What an amazing discussion. Thank you for making the time. I know it's incredibly busy and so many of you are preparing to go off to COP27. So I really can't add anything to that conversation. I have to bow to all of you for the amazing insight, knowledge that you've shared. Thank you to the audience for the great questions as well, and look forward to hearing back from all of you after COP27. We'll circulate the recording, we'll circulate the white paper from the AFC, from the Prudential, and we look forward to continuing this conversation with all of you. Thank you, Nazmira, very much for sharing. Thank you.